investors should be very careful that you love the thematic, you can see the scale, you can see the opportunity, but you can actually pick the wrong horse in a great race.
When we look at resources, we assess companies on what we call the 5 forces of resources. So mine life, cost, country, management and exploration upside are really the 5 key things we're looking for in a mining company.
But I do think that there's both a need and an opportunity on the energy transition side to find ways to make these projects happen. Because as you say, traditional finances are not there.
Let's welcome to the stage John Dorian, Investment Manager at Orion Resource Partners, Matt Griffin, Co-Portfolio Manager at Maple Brown Abbott, and Rick Squire, Portfolio Manager at Acorn Capital. All right, so I'd like this to be a slightly interactive panel today. So we have staff from the hotel with a microphone. So if at any point you have any questions for the panelists, don't wait till the end. Just throw up your hand and we'll get a mic over to you. And we want to hear from you and what you want to hear from them. So I thought we could kick off the panel looking at a global perspective. So how is the current geopolitical environment impacting the metals and mining industry? So thinking of such issues as the Russian invasion into the Ukraine, US-China tensions, and more. How are these impacting supply, demand, and pricing, and where are we in the mining cycle? So, John, you're closest to me. Why don't you kick us off?
Yeah, no problem. Is this on? Yeah, okay, you can hear me okay. So I think there's, from our perspective, I think there's a few interesting features of the current market. Certainly reshoring or supply chains. I think we're seeing there's potentially an interesting dynamic where you're sourcing your materials from is becoming more and more important, and whether that eventuates in a form of premium or government support for supply chains. I think that's something we're very interested in, and what that represents in the critical mineral sphere.
I guess it's kind of interesting because ordinarily at this point in the cycle, you'd say, potentially the world's going into recession, you'd be quite bearish usually. And you'd probably see demand issues and prices falling going forward. But there are a lot of things going on in the world at the moment, which means that may not be the case, and it'll be quite nuanced by commodity. Certainly things like reshoring. I mean, the US Inflation Reduction Act is a really big driver, I think, in terms of getting that critical minerals and battery supply chain onshore in the US or in US-friendly countries. And the weaponization of energy as well. I mean, the world is short energy. There's been a massive underinvestment in that space. So that's certainly a dynamic we see for the next couple of years hanging around.
Sure, I'll just extend on that. And I think energy is probably the sector that's really been impacted by the war in Ukraine, just because Russia's such a big provider of global exports, particularly in oil, gas, coal, thermal coal in particular, but it's also impacting the coke and coal market. And then uranium, that 30% of the world's refined uranium actually comes out of Russia. So the energy sector is really impacted. And as much as we all want the war in Ukraine to end as quickly as possible, the reality is that Europe's not going to go back to Russia to source their gas, in particular, oil and gas, and there'll be a switch away from Russia for that supply going forward. So the sanctions that have been imposed on Russia, if historically you look at how sanctions get imposed on events like this, that they'll probably be in place for years, if not well beyond a decade or more. So I think the impact on the energy sector in particular is really strong, and I think it's going to impact it for years to come. But outside of that, if you go to the resources sector, for these countries in Europe in particular to switch away from Russia, it just means they have to fast track that clean energy transition. So then then again, it's like, well, we're not going to be looking for, these totalitarian states to supply the bulk of these resources. So then it's, well, where can I get my nickel and lithium and other resources? And so I think it's having a really profound impact across not just energy, but in the medium term, we'll certainly see it in resources sector too.
Well, speaking of nickel and lithium, prices for these metals have been surging to record highs earlier in 2022. What do you see happening in this space as the energy transition picks up pace and demand grows? Do you expect even higher prices to be coming?
I can kick this one off. Lithium's a very interesting one. I mean, we've just seen new highs almost every day in the lithium market, and it is an incredibly tight market. We don't see that easing until the end of next year at least. I think the bears on lithium probably underestimate just how hard it is to bring on new supply. Permitting issues, social issues are delaying projects. We're in an inflationary environment where it's hard to find workers to build mines and operate mines. And if you look back to the last lithium boom of 2017, 2018, it did take a lot longer to ramp up these projects than people thought. It was very hard to hit recovery targets. We saw some of these projects taking years to actually get to nameplate capacity. And I think that's probably no different going forward. A lot of the new projects out there in lithium are relying on direct extraction technologies, which can be hard and do vary by resource. So I think through the medium and longer term, lithium can continue to trade well above the cost curve, just given the demand growth out there and the supply issues. Nickel, from my perspective, is a bit of a different one. I am a little bit more bearish on nickel. There is a huge amount of supply coming in from Indonesia, potentially with slowing demand on the stainless steel side that could impact in the short term. And I guess the other thing on nickel really is, I mean, it has been quite a spiky sort of material in the past. The price has spiked up and down. We obviously saw that last year, so there can be short-term moves. But I think that's probably less likely going forward, just given the larger supply base. And the final thing I'll say is just on the battery composition, we have seen a big shift towards LFP, the lithium phosphate ion batteries, away from, most people thought would move more towards NCM, the nickel, cobalt, manganese. LFPs have been taking share. That's meant that those batteries don't have any nickel in them. They're generally cheaper, so that's why the car manufacturers are liking them. I think to be bullish on nickel longer term, you need to be a big believer in NCM batteries taking share in that space.
I'd probably just add to that. I think rather than a price per se, if I think of things from a risk-return perspective, if you look at, as Rick has commented on the outcomes of the war in Ukraine, and particularly in Europe, the policy settings that have been committed to, if you work backwards from even a simple analysis as to what those policy settings require from an energy transition, that the structural demand support for, almost all energy transition materials is fantastic. So, trying to look through short-term prices, if you're taking a medium to long-term view, I think we as a fund and myself personally find it very difficult to not be pretty excited about the structural demand support, I think, across the energy transition space.
Yeah, I pretty much agree. The only thing to sort of add to that is in the lithium space is, I'm really bullish on the opportunity, but it's a bit of a minefield in terms of where the best opportunities lie, and the reason for saying that is that there's a lot of companies touting some new technologies that have never been proven at a commercial scale, and so there's great risk. And I just always say to investors, just think back 20 years to nickel and the high pressure acid leach. You'll remember Andrew Forrest blowing up Anaconda, the Core's nickel project was a disaster. But if you go and have a look at the big nickel projects today, and you've got BHP and Glencore and the big companies that are out there running these HPAL circuits, and they're performing beautifully. But it's taken it probably took 15, nearly 20 years to actually understand that technology and to get it down to a fine art. And so now that they can start them up, and now they can get them commissioned within sort of 12 or 18 months, but that certainly wasn't the case early on. And so investors should be very careful that you love the thematic, you can see the scale, you can see the opportunity, but you can actually pick the wrong horse in a great race. And that's probably more a cautionary note on more on the opportunities rather than on the commodity itself.
Before I continue, do we have any questions from the audience? Yeah, we have one here.
Just following up on Rick's comment about the long time it took. The long time it took for these new technologies in processing to develop, which I think is a fantastic theme, and it's also being mentioned by Matt in relation to direct extraction for lithium. So my question relates to the current enthusiasm for hydrogen in relation to greener steel and green steel, and just that point is are we getting a little ahead of ourselves in terms of the full hydrogen supply chain development, given how difficult it is to store? So my question is, how does this relate to iron ore and the current trends in high-grade iron ore, particularly magnetites and things like that, as not only possibly the destination for that industry, but also a path to the future in that you can still stick it in a conventional steel mill like a BlueScope one?
Sure. Look, it's a great question. It's something we think about a lot. And, again, as an investor, you've got to think about what your timeline is. And that's why, that little example of the HPAL, I applied it to lithium. You could apply the same thing to a lot of the, the hydrogen technology around the iron ore. And so while what Andrew Forrest is doing is, is a great idea and really visionary, he's got like a 10 or 15 year time frame to actually execute on that plan. And at Acorn Capital, we take a 3-year view on our investments, but I get marked on my monthly performance. So you've got to sort of balance that up, and so you're weighted appropriately in the portfolio in terms of that risk weighting around it. But it's something that we spend a lot of time thinking about the technical aspects of it, and the risks are quite large, and again it's around where the catalysts are along that process. So I'm probably not answering your question very well, but it's for us, we're very cautious about new technologies just because of the history of the mining industry in terms of executing on them. So it doesn't mean that they won't work, but we're cautious. And if you go to hydrogen, there's a multitude of these different hydrogens. And so I've got a good friend that works for tech, and he pointed out the really good thing. He goes, this green hydrogen, but green hydrogen's no good in North America because it's dark for half of the year. So it's like, well, that's just not going to work. But he said, what we can do is we can take methane, we can split off, take the hydrogen, and then with the carbon, they can actually, turn that back in. And he said, there's a rubber plant down the road, we can set it down there. And because they've got a big manufacturing base around them, there's actually places where you can actually, take that byproduct and put it into the manufacturing sector that's adjacent to you. So what might work in the Pilbara in Australia may be totally inappropriate for Canada, but there might be something different there because they've got a different infrastructure that's set up to apply for that. And so that sort of complexity is what you've got to think about in terms of where the market is, what the opportunity is. So you've got to think beyond your backyard in terms of where the best space is to play.
I'll probably just only add to that. I think that if you look at the investment levels of in places like India and Korea and in new blast furnaces, I think there's probably a pretty long life for hematite yet. So I think there's almost certainly a lot of very exciting opportunities with hydrogen and with green steel. But you've really got to look at the total demand across the world, and I do think there'll be a huge demand for hematite for some time to come, and I think that's something that BHP would probably agree with in terms of WAIO. Yeah.
All right, so bringing it more to kind of an investment theme, as investors, how do you assess companies and potential investments? So what sort of things do you look at? Do you go by trends? What's your take?
Yeah, so at a company level, if you look at industrial companies, people look at Porter's 5 forces. When we look at resources, we assess companies on what we call the 5 forces of resources. So mine life, cost, country, management, and exploration upside are really the 5 key things we're looking for in a mining company. Risk is very important in that. Doing due diligence, site visits, meeting with industry participants, and management is really key to getting a good view on what a company is doing and the prospects. And, importantly for us, I think ESG does fit into the picture as well. We do take sustainability quite seriously. And that's really being driven by the end investors in the fund. So the super funds, the rating consultants who are rating the fund are questioning us on that and really making sure that's part of the investment process. And that's getting pushed down onto the companies. So I really think from junior companies all the way up to producers need to be taking ESG very seriously because that's what the end investors are ultimately demanding. And you're starting to see some resistance to that really get broken down over the past couple of years.
Yeah, I'd echo that. Orion's a private equity investor, so maybe a little bit different from Matt's funding perspective, but we focus on exactly the same things. I think, mine life, technical complexity, position on the cost curve, and management competency. I think if you start with all those factors in mind when assessing investments, it's a pretty universal place to start, whatever your investment theme. And I'd also pick up on, ESG is of increasing importance for everyone. It's always been front and center for Orion, given we do have investments in developing jurisdictions. It's always been part of our investment philosophy and thesis. It's in every one of our investment committee packs. But I'd echo that it's more and more important for investors, and it's certainly a focus for us.
Sure, we're similar. ESG, it's certainly been integrated in the investment process at Acorn, and but now we're formalising that more in terms of the full process that we go through in the selection. So probably one of the things we really focus on is asset quality. So one of the things that we always find difficult is picking where the opportunities are. So we're across most commodities. So we're always bottom up. We'll look at the best opportunities and go from there. We think management's very important, but good managers can leave and get eaten by a shark or something like that. So, but if you've got a quality asset, it always remains quality. The only caveat to that is and Matt touched on it, is jurisdictional risk that it's becoming more and more important. You've seen the challenges that AVZ is facing, working in the DRC. So there are certainly some countries that we just don't invest in, and we have a hard and fast rule around that. And in terms of that rule, some people use the Fraser Index or different indexes, but we use a much simpler one, which is are there large scale mining companies operating in the country, and usually the countries that have large scale mining operating there, they have an education system that's set up for mining, a bureaucracy that's set up for mining. So when you go into Africa, if those systems and processes are already in place, then it's less likely to be subject to corruption than a country that doesn't have those systems and processes in place.
So do you have like a set way that you assess risk when going into difficult jurisdictions, or?
It's really just for us. It's we do look at the Fraser Index and see what countries are rated as the extreme, and we avoid them. And there are obvious ones, Ukraine today, but Afghanistan, DRC, places like that. But then we'll add some countries to that risk. South Africa, for example, is it's not on a lot of what the extreme list, but we just find that socially it's a real tinderbox. It's a very difficult place to invest, and I've visited South Africa and been to several mine sites there. So I've been there probably 6 or 7 times. It's a beautiful country, but it's very difficult to invest a place like that. But the same thing, you can have a investment just on the outskirts of Sydney, and the social risk around that is just too great. It doesn't have to be a national park. It just has to be in a lot of hobby farms or something just out the back of Orange. It doesn't matter how prospective the ground is. It's it's Acadia, look-alike. But if it's if there's a lot of small farms and there's a lot of risk around that the social challenges, then we just don't go there. So again, it goes back to that ESG overlay. It's something that we've always thought about, but now we're actually integrating into our process to think sort of a little bit more rigorously about those risks.
Absolutely. Any questions from the audience before we continue on? All right. So I thought we could look at some of the biggest challenges to the mining and metals industry today. So you've been talking quite a bit on, the impact of the growing ESG discourse, social license to operate, inflation. How are all of these kind of posing challenges to the industry today? Also, I would say maybe the PR issue that comes along with the mining industry as noticed today.
Yeah, I think for me, the biggest operating challenges companies face today really are the inflation side on the cost end, and labour challenges as well, especially in places like Australia and Canada. So that's really posing a risk to getting projects financed, built, and operating. We've had a tough run over the past couple of years for most in the gold space, for instance. There's been a huge number of production downgrades and cost increases because people haven't been able to get staff, and there's been a lot of inflationary pressure out there. That's potentially coming to an end now, or getting kind of as bad as it could. So maybe there's a bit of light at the end of the tunnel. But I think the next step really is projects now that are in development are seeing cost blowouts. It makes equity and debt funders nervous, and that's going to be a challenge for actually getting new mines financed and built in this environment. We touched on ESG a little bit. I think that is becoming more of a headwind to the sector. Social license to operate really is key. We've seen some countries like Chile really take quite a hard stance against new mining operations, and that will take time to get worked through the system. So it really just points to the permitting side. The social side is just going to take longer. Companies are going to have to be a lot more involved earlier on, potentially with juniors, before a drill hole's even in the ground. There's going to have to be a lot more engagement on social issues and ESG, I think, in order to have a chance of getting a project up and running in a reasonable time frame.
Yeah, I think I'd add to what Matt said. I think I agree, cost, CapEx, but more, I would say, with operating businesses. I would see that as the main risk. I do think the main risk for development businesses is permitting and bureaucracy, which is, I think, increasing in every country. Timelines are stretching. It doesn't matter what country you're in. That's an increasing issue for getting projects permitted and built. Without those permits, no one can finance the project, can't get built. And also, to pick up on Matt's point, I think the industry as a whole, has not a fantastic track record in terms of performance. So we need more juniors and mid caps to meet their targets and perform, really, I think, and that will attract more investors.
One thing I'll add is this on the financing risk that traditionally, if you go back 15, 20 years, you think about the resources sector, you're thinking about gold, copper, lead, zinc, iron ore. These are commodities that could be hedged, and banks were quite comfortable lending to them. And if you think about the clean energy transition, you think about commodities like lithium, nickel, cobalt, rare earth elements. They're not commodities that you can hedge, and they're not commodities that the banks are lending to. And while the market's really hot and the equity markets are strong, and you're seeing a couple of the off takers coming in providing some support, it's not always there, and it's not always on the best of terms. And so there's a risk around the financing of these projects that investors need to be aware of. That it's not as easy in a bull market. It's easy, but if the market just eases back a little bit, that there'll be a real risk of a couple of these projects becoming stranded. Where, yep, they've got a really good project, but getting the finance, getting that final bit of capital across the line, because if you don't get the financing set up and you have a little bit of a commissioning issue, it's not as easy as pulling the drawing down a bit of additional debt like you might have been able to for a like a gold project or a copper project in the past. So that's something we're really mindful of when we're thinking about the investments, is that their ability to fund them. And so a lot of them, if you do have a good lithium project, and we're seeing it today, that the equity is a much larger part of that solve than it certainly has been in the past.
So you talked a bit about kind of the energy transition and how it's much more difficult for these projects to get funded. With the kind of looming supply shortage that we're expecting, how is this going to impact the energy transition overall?
I think to pick up on what Rick was saying about the financing challenges, we see that as well. That's kind of Orion's business model, is to try and step in to those gaps that are formed by traditional banks and other traditional financiers. So we'd agree with that point. I think on some of the more technically complex areas of the energy transition, I mean, rare earths is very, very difficult. Lynas is obviously the leader and had huge numbers of challenges in terms of getting their businesses up and running. So rare earths and other more technically complex industries, I think maybe will need different types of support to get going, and whether that's in the form of government, underwriting or subsidies or price guarantees, not sure. But I do think that there's both a need and an opportunity on the energy transition side to find ways to make these projects happen, because, as you say, traditional finances are not there. And I would say with some of those industries, there's good reason, because of the technical complexity involved and the uncertain timelines to get these businesses up and running. So I do think that would be critical to meet the energy transition requirements, is for all stakeholders to think pretty dynamically about how they're going to get these businesses up and running.
Yeah, I think government and offtake partners really play a key part, and we're seeing it with government at the moment. Subsidies are in place for EVs, for building facilities within countries, and also government loan programs. So the US Department of Energy here in Australia has a couple of government schemes as well. So that really is helping to fill the gap on the debt side. The other thing companies can do, you can't hedge, but you can go to an offtake partner and lock in a price. So we've seen Syra Resources on the graphite side, for instance, building their downstream anode material plant in the US. They've gone to Tesla and got a fixed price offtake, and that's enabled them to say, taking some of the risk out of the project, being able to go to debt financiers and say, well, this is the profile of at least the majority of the cash flow of this asset, and it makes it a much more attractive operation in terms of financing.
Yeah, and I think we'll get more into this topic about offtakes and the role when we get into the batteries panel later on this morning. Looking back at ESG, how can mining find its place in a world of ESG-focused investment? What are some of the key considerations for investors, and how can miners best position themselves in this environment?
So, look, Orion is a signatory to the PRI. There's a number of other institutions that provide guidance as to responsible mining and responsible resource extraction. I think companies can certainly look to these institutions where relevant for their business in terms of how they operate, and I do think there is an opportunity, particularly in the gold space, for people to be leaders in this front, and to really take a very active role in both decarbonisation, which obviously I think many investors are focused on, but also development philosophy. And I think these are things that a lot of companies do anyway, It's really about how they package it up and how they really bring investors, particularly generalist investors, which have been, I would say, absent from the market for a number of years now, principally, I think, due to performance. But whatever the reason is, they have been absent for some time. And if we want to bring, as an industry, those generalist investors back in, the industry does need a better job of really telling investors what they already do. I can see Morgan there. Morgan's done a huge amount for his business. So telling investors what they already do and packaging it up according to to a lot of these global institutions that really are out there setting guidelines.
Yeah, I'll just add to that there's a real education piece that needs to be made from us to the general public. That we talk about the new opportunities, whether it was hydrogen or whether it's the lithiums and rare earths or whatever it might be. But it's also important to recognise that it's a transition. It's not a big step that's going to occur tomorrow afternoon, and it's a transition that needs to be made not just by the wealthy but by everyone. And what can happen, and what you're seeing, particularly in Europe at the moment, is you get a big increase in power, and the wealthy people are only spending a few percent of their disposable income on energy costs, on petrol, oil, and gas. So if energy prices double, well, it doesn't really impact their lifestyle. But the poorer people, they're probably spending, in some cases, 10 or 15% of their disposable income on energy. And so when it goes up by 50%, that they know about it every day because they're filling up their car a couple of times a week. And so it's important that we bring everyone along on this transition and to recognise that, okay, well, if we do need oil and gas and coal, coal is coke and coal, as we all know here, is used to make high strength steel, and you can't make high strength steel without, can't make a wind turbine without high strength steel. So it's going to be part of that transition, and to keep it affordable for everyone. And so there should be no shame in the fact that we educate the public of the importance of that transition. And as much as we'd like it to happen quickly, we've got to bring everyone along for the ride and not just the wealthy. And yes, there's some great things. And while we should talk about lithium and graphite and cobalt and whatever it is that goes into the EVs, they're also just traditional sources. So I don't think we should be ashamed of mentioning that.
Completely agree with what Rick and John have said. I think the only thing I'd add is just to say that people need to view it in terms of materiality. So there are a lot of people who think it's a box-ticking exercise. You just need to comply with this sort of checklist and get through it. But really what companies should be doing is engaging with investors, engaging with regulators, communities, and working out what actually matters and what's important, and really spending their time on those issues, because what matters from an ESG perspective is going to vary massively between companies, countries, and projects. And I think that's really where we need to head. The other thing I'd say is it's very easy for everyone to come out and say, well, we're going to be net zero by 2050 and not really have any proper way of explaining how they're going to get there. So we want to ultimately see substance behind the plans. If you're putting environmental targets out there, we need to see, well, what's the path going to look like? What are the steps? And link that back to executive remuneration as well. We are seeing some leaders actually in the field start to say, well, 20% of your short-term or long-term incentives is going to be linked to sustainability targets, and actually getting on that roadmap to hit the longer-term objectives.
How easy is it for the juniors compared to the mid-tiers and majors to have that stronger focus on ESG? I think there's kind of an idea that financially it can impact them. What's your take?
Yeah, it's definitely a lot more difficult for the juniors. The majors have money and people to throw at the problem. They can have full-time sustainability managers, people engaging with communities and governments on different levels sort of all the time. So for juniors who are cash-strapped and struggling for finance, it does become an issue. But I think what they need to keep focus on is it really is becoming a lot more critical to the project. If you don't engage on ESG at the early levels, it will lead to delays later on. It could lead to community or government issues. So it does become a critical function, and it might mean that CEOs or other people within the company have to wear a few different hats and take ESG into account a bit more earlier on.
All right.
I was just going to add to that on the the in terms of becoming carbon neutral, we've got to be careful about what we see as the important targets. So at Acorn Capital is a generalist fund, and we across a range of sectors, and so we work with a couple of groups in terms of trying to understand the emissions of the companies that we invest in. And one of the real challenges is if you're an incumbent producer, you can sort of map out what your emissions are, and you can moderate that over time. But if you're a small and a growing company, well, that growing company, the way they often calculate these emissions is, well, you're scaling up, you're pouring a lot of concrete, you're buying a lot of steel, you're actually going through that really a big growth phase, and that growth phase is really carbon intensive. And so you've got a small revenue base with a really large relatively large emission base, and so the numbers around that actually look terrible. And so what you've got to do is actually look into the future. And so Acorn, for example, invests in a company, Calix, developing this fantastic technology around carbon capture, which can be used in cement production and lithium production. It's really exciting technology, but that company's got very little chance of being carbon neutral in the near term, because it's going through that really expensive, really important growth phase. So if you just sort of market and say, oh, I'm only going to invest in a carbon neutral company, then you'll never invest in companies like Calix, or you'll never invest in an expanding lithium producer or graphite producer. And so we've got to be careful how we actually measure these things, and then think more about, well, where's it going to be and how's it going to compete in the future, rather than where will it be this year or next.
I just pick up on that. I do totally agree with Rick. I think the discussion is and is becoming more nuanced with investors. I think that it's a super fast moving naturally. I think it's a very young industry, but the ESG lens is evolving very quickly, and I think it's moving away from box ticking, which is not really helpful for anyone in any industry, and moving far more towards trying to have a holistic view of assets through the life cycle. Making emissions to abate emissions, which is fundamentally underlying the extraction of things like lithium and copper. So I think our view is that investors really are becoming a lot more nuanced. But the flip side is it's relevant to every investor. So every investor is thinking about ESG. But I do think that the conversation becomes a lot more nuanced as time goes on.
Do we have a question?
Yeah, I think it's a very general question. Sorry, it's just a very general question. I think so. We're talking about increased demand forecasts for the energy transition. I mean, we're the supply side in this room, more or less, or the supporters of it. It's different for different metals, but do you think these forecasts can be met? Can we achieve net zero by 2050, which is a slightly different question? And if we can't meet these forecasts, what does that mean? Do we have to keep combustion for longer? Is it? So that's my question. Do you think that we can meet these demand forecasts or not? I'll start with Matt Griffin.
Thanks, Trent. Good question. I mean, and look, that's really the challenge we face. Everyone's seen the demand forecasts, and you look at the projects that are out there and the deposits that are there, and there's a massive shortfall. So, on the lithium side, you do need things like direct extraction to work to have any chance of reaching those forecasts. I think it's going to be a massive challenge, especially when you've got some countries who host a lot of these deposits really on the back foot and opposed to new mining. So I do think it's going to be an issue. That's why I think these commodities continue to trade higher. Potentially, you need new technologies to come through to make batteries and other sort of things less materials intensive. Well, sodium-ion batteries could, come and fill part of that gap as well. So from where I sit, I think it's going to be a massive challenge. I think technology is going to have to play a big part. And I do think there's probably a longer future for combustion and fossil fuels than people would, some people would think.
Yeah, I think it's actually good to have a pretty bold goal, and so I think whether we get there, look, I don't know. It's actually it's a massive challenge, and it requires a lot of assumptions around new technologies coming in. And just go back to the HPAL example early on, that if you said, 20 years ago, can HPAL actually have an important role in nickel production, you'd be laughed at. But it's a different story 15, 20 years later. And so the same thing around lithium. You think about the lithium producers today, the recoveries are 55%, 60% at best. Well, what if technology comes along and just the basic, forget the direct lithium extraction, just basic spodumene guys can actually start to recover 80, 90% of that lithium. Well, that's a gigantic increase, and that's no additional mines. That's improved efficiency on the existing operation. And then you then get some efficiency out of these lithium brines, and again, there's a lot of lithium that's not working, and a lot of the brines that's been sort of returned back to the salar. So if we get some improved efficiency out of that, that's what'll come in. And so I think we can get there, but I think what we'll see is all the case. Always the case is there's a lot of players that come in, then you quickly get whittled back to a small field, and a lot of the hopefuls don't actually cross the divide into production. But look, I think it's something that there's just enormous support. It's whether it's government pressure, whether it's investor pressure, or it's social pressure. There are three major drivers for this clean energy transition, and I don't think they're about to change.
We have another question.
Look, just taking the ESG concept a bit further down the track, it's going to increase the capital and operating costs of all these resource projects. And so it's at some stage it's going to have quite a big impact on price. The other aspect that we've got is declining ore grades in almost all commodities over time, and copper's an excellent example of that. So when do you think there will be pushback on the demand side as a result of higher prices for these very, very valuable materials?
I don't necessarily know that in every case that ESG would involve a significant increase in cost. I'm sure it does in certain circumstances. I would observe from our own portfolio and the way that we invest, it's more about the way people operate as opposed to necessarily what they're doing in terms of cost and capital. Things like consultation with communities or with stakeholders is cost free. It is consultation in its essence. So I think I would just my personal view is it's more about the way we do business, and as Rick and Matt have touched upon, education and making sure that everyone's bought into the same path and the same journey. But I'm not sure necessarily it's going to cause a jump up in the cost curve. I think declining grades, I would totally agree. It should have some impact in the longer term. I think honestly the regulatory and bureaucratic burden will restrict supply far more than ESG, which is not really ESG. It's more about getting permits on time from regulators and having regulators see the industry as something they really want to promote. I don't think that's an ESG issue. I mean, technically it's part of the S, but I think it's something that regulators should be doing far more to promote.
All right, we had a question over here.
Tony Roach from Mount Malcolm Mines. Coming from a major a year ago where we were actively pursuing ESG and integrating that into our business, we really sort of took a different line as far as what a lot of people view ESG as in measuring sort of bulk sort of energy use and coming up with measures such as putting in solar farms, etc. We're really looking at getting back to the brass tacks and looking at the processes that we have within the company and improve those processes going forward to basically bring it down to cost basically calculating cost savings and efficiency in the way that we do. So, looking at simple things like man hours. So we're really focused on sort of the benefits to the company that ESG can bring, rather than being a restrictive or cost prohibitive measure that we were forced to undertake. So, and as sort of in a technical role in that company, we actually took it as an advantage. So going to a junior with Mount Malcolm now, I'm looking at it in the same way that we don't have massive amounts of money to spend. We'll in the near future we'll be looking at building mines, spending money, and as Rick was saying, that the juniors potentially, if you look at ESG just in terms of the amount of concrete you pour, etc., those factors, are obviously going to mark us down. But it's really about getting back to the process. And I guess my question to you is that, would you view, in marking, your ESG box, would you look at the companies and would you look at sort of the gross sort of measurables, in terms of, energy used, versus, the scale of the company, or would you actually look at what the company's actually doing to improve the efficiency, costs, and the amount of resources that they use in their processes?
Yeah, it's a good question. So one of the challenges when you go and have a look at all the ESG service providers, the data is always backward looking, and Tony's touched on the point. And then as an investor in emerging companies, those developers that are trying to get into production, backward looking is no indication of where the company's going to be in the future, and so that's why we're coming out with our own systems to measure, which is I think what Tony's trying to get towards, and so that's what we're actually trying to see where the great opportunities are. And so it would be like a lithium producer, or even if it's an oil producer, and say, okay, this company's producing oil, but they've got their carbon emissions are going to be quite low. And so I'll give you a good example is Cooper Energy. It's one of the first major domestic gas producers in Australia to actually be carbon neutral as of today. So they are producing gas, and their scope 1, 2 and controllable 3 emissions are net zero. And so the advantage so that's okay, nice thing. They can go out and say, oh, we're scope 1. It's like, well, so what? Well, when they went to get financing, needless to say, all the banks were all over them, because they thought, oh, here's a great example where we can invest in the oil and gas industry, and we're actually producing, it's producing gas, but it's got the lowest possible footprint, because the scope 1 and 2 are zero. And so why are they zero? Well, they're just conventional gas, reasonably simple processing, and they've bought a small number of offsets just to offset the production and the refining of that gas before it goes into the pipeline. And so that's where it's actually lowered the cost of capital, because some big banks have come in and said, okay, we want to support the energy industry, but who's the best one to do it? It's the ones with the lowest possible carbon footprint. So there's actually an advantage that can come from this, and I think we need to think about those opportunities and say, well, there's Cooper Energy, they're doing something which is a little bit different to the others, and it's actually it's a good story. Even though ultimately, yes, there are scope 3 emissions associated with burning that gas, but as I said, that goes back to it's the energy transition. It's not something that's going to happen in one big step.
I'd echo that as well. I mean, particularly on the decarbonisation side, if you looked 2 years ago, 3 years ago, would you consider anything other than a sort of gas turbine? Probably not. But when you now look forward, if you're a company trying to plan a 10, 20-year business, well, what's your gas price assumption? I don't know. I'm not in the industry, but it's certainly higher than it would have been 2 or 3 years ago. It's certainly more volatile. And in an industry obsessed with costs, the idea of having a fixed cost, for 20% of your overall operating cost is potentially quite attractive. So thinking about, and that obviously is a trade-off. I mean, that's going to be a trade-off like any other trade-off. But to not consider these opportunities as well as risks, I think is missing the point, both from a pure business owner perspective. Wouldn't you rather have a fixed power cost for the next 20 years? But also, what that brings you, as Rick has said, in terms of cost of capital, investor appetite, breadth of investors. I think it's important to think of it in opportunity as well as risk. And these are not, this is not greenwashing. These should be real opportunities and real risks that you're avoiding.
Yeah, I think it's a great question. And really, when we look at a company, we're less worried about where they are now. We're looking at companies to invest in for the next 3 to 5 years. So we want to know where that company is on their ESG journey, what they're committed to doing, the systems and processes that are being put in place to look at opportunities and risks in the space. And with smaller companies, it's going to be hard to tick the box and do everything right. So that's why I say focus on what really matters for the company, what's going to matter for the end investor, and really spend your time on those ends rather than trying to tick every ESG box out there.
So I'm afraid we're running out of time. We do have a presentation coming up next, which is going to continue this discussion on risk and ESG. So I'm sure Matt will take your questions during that presentation. But just as a quick roundup from our panelists today, thoughts on the industry moving forward? Where do you see things going in the next couple of years?
Yeah, great question. I wish I knew the answer to that. It's, I'll probably go back to where I started, and it's very nuanced by commodity, I think. In general, the macro environment looks pretty poor out there. So you'd say that should be bad for most metals and most bulks, but you do have a situation where supply's been very constrained over the last few years. You've got companies onshoring, the supply chains are being lengthened. So there's a greater demand for materials overall, I think, and it's hard to see supply ramping up materially in the short term. So certain commodities, I think, can do very well. There will be some of the more traditional ones which might struggle if there's a global recession. And I think the energy theme and the decarbonisation theme are here to stay.
I think that's a great answer. And it's very difficult to make predictions, especially about the future.
Yeah, I agree. I just think you go back to the start, we talk about the geopolitical tensions, this clean energy transition. I think they're going to, override the negative sentiment, but it'll be a rocky road.
All right. Well, let's give a thanks to our panelists for kicking things off today.